In this video, we're going to see how you can use LV Financials to help you determine if the interest that you will pay on your mortgage is higher than the home is actually worth. To do this analysis, you will need a paid account. Go to the Tools drop-down in the top right and select the Loan Planning Dashboard. Go to the Amortization Schedule tab. The principal is the amount of the mortgage, or the amount that you are borrowing. Let's suppose that you are buying a $400,000 property. If you assume that the down payment is 10% of the principal, then you would be putting down $40,000. Let's start off with a low interest rate of 4%, and we'll leave the loan term length at 30 years. The number you want to look at is in the Loan Details table on the right. The total cost of the loan shows the total interest that you will pay over the lifetime of the loan. You can see here that it's $298,000. You can compare that to the principal, $360,000, or compare it to the principal plus the down payment, since ultimately that is the amount you will pay. In this case, the total cost of the loan is less than the cost of the house. However, let's play with the interest rate to see what happens if we increase this to 6%. Now when we scroll down, you can see that the total cost of the loan has gone up to $457,000, which is much higher than the actual cost of the home. So what this tells you is that you should find a lower interest rate than 6% so that you won't pay more in interest than the home is actually worth at the time that you buy it.